Okay, we hope that you enjoyed that talk on how to deal with disputes. Next up, we have Aisha from Kelley Hunt, who's going to be taking us through a talk on how tokenized ETFs bring Wall Street on chain. Aisha, welcome.
Hi, I'm Aisha Hunt. I'm the founder of Kelley Hunt, PLLC. It's an ETF and tokenization law firm based here in Denver. I'm very focused on representing institutional asset managers. I've represented multi-trillion and multi-billion dollar institutional asset managers, in particular ETF issuers. Right now, we're going through a revolution where we're focused on basically transitioning various financial products, institutional collateral on chain. And what that looks like really requires us to take a step back and think about the last 3 years. So in the last 3 years, we've been trying to ask the SEC for permission to launch what are referred to as dual share classes. This is where a mutual fund can add an ETF share class, or an ETF can add a mutual fund share class. When a mutual fund adds an ETF share class, they're doing that to benefit from the tax efficiencies of the ETF wrapper. When an ETF adds a mutual fund share class, they're doing that to access 401k distribution. And the reason why everybody's focused on this is because the combined total assets for mutual funds and ETFs are 45 trillion. 15 trillion of those assets are in ETFs. 30 trillion of those assets are in mutual funds, mostly held in retirement accounts. So throughout a lot of the sessions, at ETHDenver, we're talking about how we can lean into institutionalization and bring further legitimacy to various projects. And so this regulatory work that I'm doing and others are doing to, one, be able to launch dual share class funds so that you can leverage both a mutual fund and ETF wrapper is really about accessing 45 trillion in assets that are existing. This isn't about raising new assets. This is about essentially transitioning those assets now on chain. So we were the first to propose on behalf of our client FM Investments to the SEC to tokenize ETF shares. What does that mean? It means essentially offering digital representation on chain of ETF shares. And doing that on top of dual share class relief not only allows bringing those ETF assets on chain, but also additionally mutual fund assets where a fund is relying on this dual share class relief. So we're really excited about the work we're doing from a regulatory perspective, especially as we see, multi-claw and other, agent capabilities and AI build out those agent capabilities. Those agent capabilities inherently require being able to move collateral on chain. And so specifically for my client FM Investments, we have, obtained relief to launch dual share classes. This is a $6 billion ETF. So these are real assets that are currently regulated under the Investment Company Act of 1940 and the 1933 Act. And so what we're doing here is we're leveraging a regulatory protection stack. When you think about a treasury bill, a 3-month treasury bill, it's considered the most liquid and the most safe collateral that one can own. Literally, the issuer is the U.S. government. And so when you're taking a treasury bill, a 3-month treasury bill, and you're wrapping it in an ETF, you're essentially then applying a 40 Act protection for the actual fund, but you're also applying a 33 Act protection layer with respect to the fund shares. So you have the T-bill issued by the U.S. government, you have the 33 Act protecting those fund shares, and you have the 40 Act protecting the fund. So that regulatory protection stack is really the format for thinking about how do you build within that regulatory framework a tech stack that can support tokenization of ETF shares. And why is this important? Because we're entering a time where agents could be misaligned, and that's going to continue to evolve. And so how do you create a digital Fort Knox to protect the most liquid, safe collateral and move that on chain and further institutionalize a lot of projects? And so we're really interested in understanding how big institutional players like NASDAQ, the New York Stock Exchange, Coinbase, Securitize, and others are looking at their tech stack and how they can support tokenizing ETFs. Because again, this is accessing collateral that agents will need and as they expand their capabilities. And as we look at even the evolution that's going on in terms of building for Web 4. So we think this is a really important project where a lot of folks should be very interested, because again, this isn't about raising assets. This is about tokenizing existing institutional assets and creating protections around those assets so that people view it as a safe space in the crypto ecosystem. So I'll pause there and take some questions. I know we might be a little behind today. Yes? So to our proposal to the SEC on behalf of FM Investments, we've made it agnostic. So we're looking at projects that people are developing at the various big players, but new players as well, to see what on-chain protections make sense, what tech stack makes sense to protect a $6 billion ETF, right? So we view it as another distribution channel to tokenize, and we're really excited about what we're doing from a regulatory perspective, and now we're looking for the tech stack that will plug in to really ensure that shareholders are protected, right? Any additional questions? Well, thank you all very much. Really appreciate your time and looking forward to continuing this regulatory journey and the tech stack journey. Thank you.